So let's start from market structure. The thing about market structure you need to understand is that in an uptrend, you buy. Hold on. So as you can see, this is the course outline. We have the beginning market structure. Second one, how to identify fair value gap, FVG. Third one, Fibonacci, and so on and so forth. So we're taking the first one. So I was explaining market structure. Basically, there are three types of structure. You have the uptrend, downtrend, and you have the consolidation market. So now the uptrend, what do you do in an uptrend? You buy. In an uptrend, you buy. In a downtrend, you sell. In a consolidation market, or you can call it consolidation, you can call it choppy, you can call it ranging, whichever one. They all mean the same thing. That type of market, you wait for market to change structure back to a bullish market or bearish market. What do I mean by bearish or bullish market? A bearish market is a downtrend when market is selling. A bullish market is an uptrend when it's buying. And a bullish market is an uptrend when the market is buying. So now in an uptrend, like I'll say, you buy. In a downtrend, you sell. So now we're going to look for how we're going to buy. Now we're going to look for how we are going to be buying and how we're going to be selling. The risk management, the right time to buy, the right time to sell. Please, what are you writing on the board? What are you do you want to teach them? So you're looking for the right time to buy, where to actually buy and sell, the risk reward ratio, which is your RR, and so on and so forth. So let's start with the first one, market structure, which is your uptrend. Now your uptrend, a trend consists of the external structure and the internal structure. So now in an uptrend, you're having this swing. Hold on, I'm coming. Let me change this stuff. So in an uptrend, you're having this swing high. It's swinging from this low to this high. So this is the swing low, this is the swing high. Then this is what you call the external structure. This is the structure that is outside. Don't forget, we're starting from the uptrend. Then you have this internal structure. The now internal structure is the structure that is within this your external structure. So this is your internal structure. So you have this for your uptrend. So now this is no longer your swing low. This is now your swing low because the lowest point in an uptrend, the lowest point is your new swing low. That is the lowest point in this your internal structure, not this low, not this low, not this low. This is the lowest point price got to before it takes out this high. So that lowest point is your swing low. So this is your swing low. And the process of price taking out this swing high. Now note, in an uptrend, price needs to be taking out the swing high, which is the external high I explained. Don't forget, this is your external low and high. So it needs to be taking this external high for a continuous uptrend. It needs to be breaking it to the upside. So you can see you have this high taken out, that's the break of structure, and this is your swing low. Then you have this new internal structure. You can see it's just this high is protect. This low is not being taken out. So it's going to go up and take out this high again for a continuous uptrend. So you can see after it takes out this high, the process of price taking out this high is what I explained as a break of structure. So continuously is what makes price an uptrend. It needs to be taken out the swing high or the swing high. When you see price action an uptrend, taking out the swing high, it is a break of structure. That's a continuous trend that the price is bullish. So that's for the uptrend. Now, what happens if you take out the swing low? I said the lowest point in your internal structure is your swing low. So what happens if price action retrace back and take out the swing low? If you take out this swing low, that is what you call a change of character. If it's taking out this swing low, that is what you call a change of character. Now, an uptrend, price action take out this swing low, it's a change of character. Now, this is what you call an impulsive move. When price is buying, when price is buying, that is taking this high. If it's taking this high like this is what you call an impulsive move. The process of price buying, taking out this high is an impulsive move. Then this is the retracement. When it is selling, that retracement, when it's correcting to the downside, you can call it a retracement, a pullback, or a correction move. That's what you call this move happening. So the next one that is going to buy to take out this high is also what I call impulsive move. So that's how the market happens with impulsive move and a retracement. So as you can see, impulsive move, retrace, impulsive move, retrace, and impulsive move. So this impulsive move, the candles are always lead to like 1, 2, 3, something you can count. But this retracement is like a lot, hundreds of candles that can make this retracement. That's how you know that price is currently retracing, that there's sellers in the market that are trying to go to a point to start buying. So the next one is an impulsive move, then a retracement. And that's what makes us an uptrend. Taking out this eye, this swing eye, is what price action is within. And I said if it takes out this low, it is changing character to a downtrend. Do you guys understand what I just explained? Can you guys hear me? Or my mic has moved beyond sync. Can you guys hear me?
Yes, yes, we can hear you.
Yes, sir.
Okay, so that's what makes us an uptrend. So now for the downtrend, you're going to be having this external structure again. You're having this external structure, then you're having this internal structure. So in a downtrend, price action should be taking out the swing low. Don't forget the uptrend, it should be taking the swing high, but downtrend should be taking out this swing low. So if it's taking out this swing low, you're now having a break of structure, that it is breaking the structure to the downside. Then you have this external structure, then internal structure. Then the highest point in your internal structure is your swing high. Then you have this internal structure again. Then you can see that highest point is your swing high. So continuously is what makes this trend a downtrend because it is breaking the swing low. If price action is breaking the swing low, it is a bearish market, or you can call it a downtrend, whichever one. So you can see this is what makes it a downtrend, taking out this swing low. So if, like I said, the highest point in a downtrend, the highest point in this internal structure, the highest point is your swing high. So what happens if price action now retrace? And in a downtrend, this is an impulsive move, this is a retracement, this is an impulsive move, this is a retracement. When market is selling drastically, it is
Your network is breaking.
Can you guys hear me now? I don't know what's wrong with that by this time. Can you hear me?
Yes, we can hear you.
I don't know what's wrong with that by this time. So I was saying in this downtrend, this is what you call the impulsive move. This is what you call the retracement. Another impulsive move, retracement, another impulsive move. And like I said, the impulsive move is always consists of few candles, something you can count. But the retracement is always consists of hundreds of candles. You can, if you see it, you know that yes, this is a retracement happening in the market. So in a downtrend, you should be taking out the swing low. All these swing lows is where what price should be taken out. So what happens if it retraces and take out this swing high? It goes up like this and take out the swing high in the market, you're having a change of character. So you can now see how price action change from this bearish market to this bullish market. But still, it is not yet a bullish market. The only way we can call it a bullish market is when price has now given you a bullish break of structure. If it goes down like this and take out this high, you now have a bullish break of structure. As you can see, we now became bullish now. From this bearish, we became bullish, and from this bullish, before we can call it a bearish change of bearish market structure, is when you have this bearish break of structure. Do you guys understand this basic market structure? I mean the advanced part of this market structure now.
Yes.
So that's just all about market structure. Now don't forget, because I'll be sending the video to the Telegram course channel. If you don't understand, you can go through it again. Don't do the mistake. This is where people make a lot of mistake. Don't do the mistake and start marking all this internal structure as a break of structure. Don't do this mistake and start marking all this internal structure. When price action break from your external structure, this is your external structure, is where you pay attention to, not all this low, not all this internal structure. You can look at this level, not all this internal structure. Now for your consolidation market is when price action gives you something like this. Now if you see price action failing to break this high and low, it's just consolidating, it's ranging within that high. You can see. You can see price failed to break this low, it failed to break, it's just ranging within them. It is given this internal structure that failed to break this high or low. That's what you can call an internal structure. So now let's check live charts and see how it is in the live charts. So now let's use gold for an example. We understand that gold has been bullish, but before it became bullish, we were bearish. Price action move from bearish to bullish, from bullish to bearish. So now let's see this one for an example. In this market structure now, market is bearish. How do we know it's bearish? We have this swing high, this swing low. This is your external structure now. It now give you this internal structure. Don't forget, this is your external structure. Don't do the mistake and start marking this one. This is where it swing up to before it retraces. So it is this low you mark as your break of structure. So after that break of structure, you can see it went up again, did this internal structure. Then this low is where it took out for a break of structure. So you can see you mark this low as your break of structure. This is your break of structure right here, and this is your break of structure. So now we understand we are bearish around this level. So you can see this level, we have this break of structure, break of structure. So what do we call this market now? When price fails to break this high and low, you can see what it's just currently doing. What do we call this market? What do you call this structure?
Consolidation.
Consolidation.
So you can see it's consolidating.
Ranging market.
Good. Ranging market consolidation. So you can see after this bearish market, I said in a downtrend, if price action now take out this high in a downtrend, which should not be happening. If it takes out this high, what is it called?
Change of character.
So you can see price action took out this high from this
Change
bearish
of
market.
character.
So you can see from this bearish market how we became bullish. So you mark this as your change of character. So this was where we changed character to bullish price action. So now let me explain something to you guys about a valid pullback or retracement. When you have this pullback, you need to have at least this pullback. You need to have at least half of it like this. If it is tiny like this, it is not valid. Let me make it large for you so you understand. If it is a tiny pullback like this, it's not valid. Look at this one. You have this pullback, this retracement. You need to have at least, if it's half like this, it is valid. If it's like this, if it's like this, it's still valid. But if you have tiny one like this tiny one, this pullback is not valid. Don't do the mistake and mark this low as your swing low because it's not valid. Same thing happened here when you have this swing structure, then it came here, then it broke structure here. This was where it initially broke structure. So what I'm trying to explain to you guys is don't do the mistake and mark this as your pullback. Don't do the mistake and mark this as your new break of structure. No, this is still your break of structure. This is where price swing from here to here because it is not up to half of this pullback. This tiny one is not up to half of this retracement. So that is not a valid pullback. So this is your break of structure. Then what can we see in the market again? Continuously is what gave that structure. Then we have this uptrend, higher high, higher low. So don't start marking all this internal structure. All these structures are your internal structure. Don't start marking them. They're your internal structure. This is where you mark as your break of structure. Don't mark all these tiny ones again. This high is what price took out as your break of structure. Went up again, take out this high. So what can we see? It took out this low for a change of character. So after it takes out this low, it gave this bearish change of character as if it want to start selling. But what can we see in the market? It gave us a new change of character to the upside. So at this point, we add two change of character. Then after the second change of character, what do we call the first change of character? That was supposed to sell. This one that was supposed to sell after this bearish change of character, this one is what you call, this change of character is what you call a fake out because initially it gave a change of character, then it did not sell. So it is a fake out. So this second one was not the one that kept on buying. So this one was a fake out. Let's take it out. So after that, what can we see in the market again? From here, market swing high, low, high, low, higher, low, swing high, swing low, whichever one you want to call it. It all mean the same thing. Then you have this break of structure here. So don't do the mistake again and mark this tiny one as your break of structure because it's not up to half of this retracement. Can you see this retracement? It's not up to half of this retracement, so it's not valid. So right now we have this from this swing low to this swing high, then this low was taken out again. then this is where price currently is. So this is where you mark as your break of structure. And in the uptrend, you can see where it took out this low. And your uptrend, if taking out this low, you're having a change of character. So this is where you're having a change of character. I'm confused. Okay, Kashi, what are you confused about? What's making you confused? You can on your mic. Let us hear you out. What are you confused about?
Okay, I'm confused about that first change of character. All those things can they be
This one?
signed
Is it
as
this?
a break of structure? Yes, after that change of character.
Is it this one? Yeah,
And
this
all
one.
those things can they be called?
This one.
Yes, can it be called? Is that a break of? Yes, is it a break of
Yeah,
structure?
it's a break of structure. I said it's a break of structure. Then you have this pullback. Then you have
Okay.
this impulsive move. It's a break of structure. There is a break of structure. I don't
And
just want to mark
exactly.
line on the chart. Yes. So you have this as your change of character. Then it went up, came down again, took out this eye for a break of structure, went up again, came down, took out this eye for a break of structure. I don't just want to
Okay.
put line on the channel. I want to
Okay.
quickly because we have a limited time. We just have 2 sessions and we have to cover everything. You
Yeah.
get.
I understand.
All right. So currently, this is our 1 hour change of character. So this might potentially be a fake out again if price action goes up to take out this eye. If it takes out this eye again, this will potentially be a fake out. That is, early sellers may think that it won't start selling from here. Meanwhile, to just start buying and give you a new break of structure. Do we all understand why I just explained this market structure now? Do everyone understand? Okay. So now let's check what is next in how to identify fair value gap. So how do you identify fair value? This one is simple. Fair value gap, you can call it imbalance, you can call it FVG, that's the meaning. FVG, you can call it imbalance. So what is an FVG? An FVG is a gap between 3 candles wick. Now look at this 1, 2, 3. The first candle wick and the third candle wick are not together like all these ones. Look how this one, how they are together. You can see how it is far, this first one. You can see how it is far from here to here. So this gap from this first candle wick to this third candle wick is what you call an FVG. Look at this level again. From this third one again, look at this 1, 2, 3 to this third candle wick. You can see this gap, but we don't use lines to mark it out. We use rectangle too. So you mark it from this first one to this third one. You can see from this first one again to this third one. So this gap is your FVG. Let's check for more. You can see all these one are in. You can see there's no any FVG here. You can see there's no gap between all these candles. You can see all of them are together. They're together. So there's not an FVG here. If you look at this one, this 1, 2, 3. You can see from this first one to this third one, there's a gap. You can see this wide one. Look at this first one to this third one. You can see the gap from the first candle wick to the third candle wick. Don't forget the wick. The first candle wick to the third candle wick. Look how this one they are together. So there's no a valid fair value gap. Do we all understand what this fair value gap means now? Are you all there? Do you all understand what a fair value gap is?
The last
Yes,
example that you're
yes.
showing, sir, I did not quite understand it, sir.
Okay, let me take it back. Is it this one? This last one?
Okay.
Is it this last one?
Yes, sir, is that last one?
Yeah, you can see the gap between the 3 candles. Look at this first candle wick. Look at the third candle wick. Can you see the gap between the first one? Look at the first candle wick and the third candle wick. Can you see the gap? This whole gap is what you use your
Yes,
rectangle
sir.
to get
Yeah.
out. So that's your FVG. Do you understand?
Okay. So what about the thing week above it? Is it still valid?
What wick above it?
Like, let's
You
say the price is retracing back to that place and the thing now weak a little bit above
that's
it.
not the point.
Is
You don't need to look for a retrace. What you just need to understand about FVG is the gap between the 3 candles wick. Forget all these ones because you are looking at it that it has happened.
okay.
This is not what you have. This is what you have in the market before it retraces into it. You have from year to year. This one are the what price action have done. So I'm telling you, if this is what you have, forget all these ones that have happened. If this is where market stop with this 1, 2, 3, That is what you identify as your FVG. Do you understand? Let me see if there's no any
Okay,
recent
sir.
one. I would have showed you.
Yes, sir.
Okay, I think this is a recent. This is not really a FVG. Let's see on the 15 minutes. Here's something we can see. Okay, this one has actually retraced. As you know, this candle has not happened, you can call this an FVG. But you can see 1, 2, 3. You can see this candle has come into it, so that's like it is no longer valid. Let's see on the 5 minutes if you can see a valid FVG. Okay, look at this one now. Price has now retraced into this FVG. Can you see this 1, 2, 3? Look at the first candle week and the third candle week. Can you see price has now retraced into it? So this is a valid FVG now.
Yes, I can see that, sir.
Okay, good. So that's the second one.
Yeah. I have a
Yeah.
question, please.
What's your
If
question?
we are to look for an entry now, are we to use a
Don't yet.
recent fair value
We're
gap?
not talking about entries. Wait, we're taking everything one by one. Entries is still I think the fourth one. Can you see how to enter and exit trade? Just leave that one for now. You understand? I want to take it one after the
Okay.
other so you understand everything one after the other. How we take trades. You understand? We're still going to go down to how to actually enter and exit trade. Do you get?
Please, I have a question.
What's your question?
Um, what time frame is best to identify an FG,
To
a fair
identify
value gap?
Identify your FVG or any analysis you want to make, be it your break of structure, change of character, whatever analysis you want to make sure it is on the 1 hour time frame. If you're analyzing, make sure it is on the 1 hour. So your FVG, your break of structure, whatever thing you want to analyze, make sure it is on the 1 hour time frame. Do you understand? Do you understand? Identify other blocks. I never even reached there. You don't need to make I go that block. Okay, if I dey explain am like that, you go understand wetin I dey explain. I just understand explain fair value gap. You see make I dey understand am. So now, Sylvia, do you understand what I just explained about the analysis?
Yes, sir, I understand.
Sorry, sir, bit by bit then. Demand and supply. If you don't see an MU on the one, can we wait? Mona, calm down. Mona, calm down. Mona just dey rush this thing. Mona, calm down. After this session, they say another session. So you have a lot of time to take. So that's for the FVG. So the third one is Fibonacci. How to use your retracement, Fibonacci retracement. So now, everyone, if you're using your Fibonacci retracement tool, make sure you double tap on it. And the settings, this is your settings. Make sure it is the same with this Fibonacci settings. It's on the Telegram course channel. So let's keep that. Your Fibonacci retracement tool, this is where you should pay attention to. This 0.5 to 0.6 level over here. It's what they call the golden level. This is where price action love to retrace into before you start buying or selling. Understand that now. So now in an uptrend, how you plot your Fibonacci? The lowest point to the highest point, this is your swing low to your swing high. Your 1 will be at your swing low, your 0 will be at your swing high, then you drag it out. Then you pay attention to this 0.5 to 0.6 level. This is where you pay attention to. This is the Fibonacci retracement to where you pay attention to. Why the downtrend? Don't forget that's for the uptrend. The downtrend is going to be the opposite, which is from your swing high to your swing low. Then you pay attention to this 0.5 to 0.6 level like this. This is where you pay attention to the price might potentially tap into before it sell. So now, let me explain how to actually use this. You don't just wake up and use Fibonacci and think it's going to work all the time. No, there are sometimes you have two fair value gaps that price might potentially tap into like this. Let's say you have this uptrend like this. Like I said, from your swing low to your swing high. Now this is what you have. I'm using this for an example. This is an example. The first one, let's say on the 1 hour time frame, you've analyzed now, you've got your break of structure, and this is the only fair value gap you have on the 15 minute and 1 hour. This is the only fair value gap you have. Now, the candle before your fair value gap is your order block. Please understand this. The candle before for your supply and demand zone. This is the demand zone I'm explaining now. In an uptrend, to identify your demand zone, the first criteria is a break of structure. Price needs to break structure or it needs to change character. So as you can see, it has broken structure right here. And the second criteria you need to identify is your fair value gap. Price needs to create a fair value gap, which is this. You can see price needs to create an FVG, which is your fair value gap. And I said the candle before your FVG Any candle before your FVG is your order block. So you mark that level as your order block. So what do you do? Now listen to this again. If this is the only fair value gap you have in the market, to take out your trades, for aggressive entry, it will be on the 1 hour fair value gap. For the aggressive entry, to be on the 1 hour fair value gap, and your stop loss will be on the 1 hour order block. Be on the 1 hour, or to be below the order block, like a little bit space below the order block, and you target a 1:3. Now, what does 1:3 means? Hold on, I'm still going to explain a lot of things. What does 1:3 means? 1:3 means you're risking 1 to make 3. If you're risking 1, you're making 3. If you're risking 100, you're making $300. Now, a 1:2 means you're risking 1 to make 2. If you're risking 1, you'll be making 2. Any trade that is going to be taken, always make sure it is minimal of 1:2. Do not take trade that is 1:1 like this. So minimum 1:2, 1:3, 1:4. Basically, if it is this 1:4, you're risking 1 to make 4. Means you're risking, if you're risking 100, you're making 400. That's times 4 of your reward. Now back to the analysis. The first one I explained is the aggressive method, taking trades from the 1 hour time frame. Now, what is the advantage and disadvantage of this aggressive method? The advantage is that in most cases, you'll be in a trade. In most cases, you'll be in a trade. That is, price still wants to retrace into this order block. You can see you're still going to be in the trade to still buy. That's the advantage. Disadvantage is your stop loss will be large. At least you'll be having nothing less than a 50 to like 80 pip stop loss. But if you have a good profit or you have a good amount, you should not be scared of taking this trade. Don't forget, the advantage surpass the disadvantage. That is for the aggressive entry. The conservative entry, you go down to the 15 minutes or 5 minutes. What are you looking for here? You're looking for your morning star. If you are buying, you're looking for a morning star. So at this point, you'll be waiting for price action to create a morning star to buy. If you are buying, you're looking for a morning star. So now what's the advantage of this? What's the advantage of this conservative entry? The advantage is that your stop loss will be much smaller. That is, once you see your morning star, it's just a 3 candle. So your stop loss will be like within 30 to 50 p stop loss. It's still going to be a little bit smaller. That's the advantage. What's the disadvantage? The disadvantage is that in most times you miss out on trades. If you don't see a morning star or evening star, there's nothing you can do. Unless you have other candlestick patterns. But me, I only advise what I've actually used and worked for me, which is the morning star or the evening star. That's for the conservative. Don't forget, the disadvantage is that you might miss out on trade. So now, if this trade comes to this level and you don't see morning star to buy, if it comes and you just keep buying, you are going to miss out on the trade just because you're looking for a smaller stop loss, which is the advantage of it. So back to the chart. Let me show you how it works on the chart now. First thing I explained is how to use your Fibonacci. So on the 1 hour time frame, now because we're in an internal structure here, that is why we just analyze the 15-minute time frame. Because we're in an internal structure, we cannot analyze with the on the 1 hour. Obviously, we already know we are having a change of character. So this was what we've been trading. Let's go down to the 15-minute time frame. So on the 15-minute time frame, as you can see, you have this break of structure here. First thing to find your order block, which is your demand zone. The first thing I said is your break of structure or change of character, which is this. So you have this break of structure. Second thing I said you need to identify is your fair value gap. So you have this, you can see you have 1, 2, 3, 4, all this fair value gap. So let's pay attention to the last fair value gap. Always pay attention to it. So now going down to the 1 hour time frame, what can we see? On the 1 hour time frame now, you can see this as your 15-minute break of structure. But your 1 hour time frame, your fair value gap is going to be large like this. Your fair value gap is going to be large like this. So this was the first trade we took. Now, the aggressive method is what I actually take, what I actually give out, the aggressive method. You take, I said, your aggressive method is going to be on the 1 hour time frame. The fair value gap, you mark it out. Then your order block, you mark it out, which is the candle before your, if you are following, I said the candle still before your fair value gap is your order block. So now your entry will always be at the tip of your fair value gap. This is where your entry will always be at. Then your stop loss will be below your order block like this. Then you just target a 1:3. This around this level here, a 1:3. So basically, you'll be waiting for price action to retrace into this level. So why do we quickly take this trade around here? I think this was from year to year. I think it was the year that I said you guys take 80% and 20% should break even. So you can see around this level, we've taken 80%, then price started retracing, then it came to 80%, then it came to our break even. So that's when we're in and out of this market. So when we see price action retracing back is there, definitely there's a fair value gap. Price action has not retracing. Then we go down to the 15 minutes back to check it out. So you can see on this 15 minutes. Okay. Let me see. I'll explain the 1 hour entries. The first one is this aggressive entry, taking trades on the 1 hour. It's the aggressive entry. For the conservative, I say you go down to the 15 minutes or 5 minutes to look for your morning star. If you are buying, you're looking for the morning star. If you are selling, you're looking for the evening star. So on the 15 minutes, I can see a valid evening star. Go down to the 5 minutes, if you see a morning star, good. So on the 5 minutes, let's see if we can see a morning star right there. So you can see there's a valid morning star. Can you see this is a morning star here? So once it closes, it's a 3 candle, 1, 2, 3. So as soon as it closes, that's where you enter your trade, and your stop loss will be below the low of the morning star. Then you target a 1:3. So you can see you are in and out of the market. This one is good for the conservative method. You are in and out. So the second day, which was on Thursday, we had another trade right here, looking at this fair value gap. So let's see 15-minute time frame. We have this fair value gap. Again, we analyze a break of structure. We have this fair value gap, price action has not happened. So that was where we took our Thursday trade from. Now some people missed, and our stop loss was below the order block. You already know your candle before your fair value gap is your order block. So the candle before, then your stop loss is at the low, then you target the 1:3. So at this point, for the aggressive entry, you can see we are in and out. For those that are waiting for the conservative entry, which is looking for your morning star, you can see going out to the 5 minutes, there's no way you see a morning star there. Can you see? There's no any morning star here. So if you are looking for the conservative method, you would have missed out on this trade. That's something about this conservative method I've always been saying about. If you're using conservative method, you'll miss a lot of trades. So now, now that you've gotten the aggressive entry, put your entry at your fair value gap, your stop loss below your order block, and you just target a 1:3. You're in and out of the market. Do we have any question concerning these entries? Do anyone have any questions? I've explained fair value gap, how to identify your fair value gap, how to identify your order block. Do you all understand what I explained about the order block, how to identify it, which you can call your order block, your supply or demand zone? In an uptrend, you look for the demand, which is still the last candle before your fair value gap. In a downtrend, you still look for your supply. It's still going to be the candle before your fair value gap. Let's say you're having this downtrend. First thing first, I say you identify your break of structure. If it's in a downtrend, identify your break of structure. Then second thing, identify your fair value gap. Then the candle before your fair value gap is your order block. So we all understand. You can call it your order block and call it your supply zone. Do we all understand, or is there any question? We have like 2 more minutes before this class is over. Then I'll send a new link after 10 minutes. So we're going to be covering risk management and liquidity. But first, do we all understand what I just explained, or do you have any question? If you don't see another video on the 1 hour time frame, can we use exactly? If you don't see on the 1 hour time frame, go down to your 15 minutes to look for your every. If you see there, good. You've asked me this question before on WhatsApp, Namkashi. If you don't see the fair value on the 1 hour, which is unlikely, go down to the 15 minutes or 30 minutes. Make sure you see that fair value gap, because if you don't see it, do not enter that trade. Wait till the next opportunity till you see it. It's very, very important to see your fair value gap, because if you don't see your fair value gap, there's no way you can identify your order block, which is your supply or demand zone. See your fair value gap on the lower
Hello,
time
bro.
frame.
I have a
Enter the-
question.
Yeah, I can hear you.
Okay, good evening, sir. There's
Yeah.
this pair on CHFJPY.
Hold on. Please give me a few minutes. And before anything, I want you guys to understand something. If you want to trade, pick just one pair and trade. Don't choose JP today. Don't. It's not every time you should be looking for pair. To give for trade to enter. It may just 1 minute. Let me just end it. I'm going to explain some things to you guys in the next class after 10 minutes. And don't forget, person not to ask questions, just jot it down or just write it down in the group. I'll answer your question.
All right.
Do you understand?